Subscribe to my channel Report Stock.
Okay, let's unpack this. When a tech giant like Microsoft reports its quarterly earnings, the headlines, well, they often just scratch the surface, don't they? How do you really get to the core of what's happening? What are the true signals amidst all those numbers?
That's precisely what we're here to uncover today.
Yeah.
Yeah. We're taking a deep dive into Microsoft's really remarkable Q4 2025 financial performance. We're using the latest reports and, top analyst insights as our compass here.
Right.
Our mission really is to extract those crucial nuggets of knowledge, helping you see not just the raw figures, but the compelling story they reveal about the tech landscape.
And what a fascinating story these numbers seem to tell. From what our sources show, Microsoft appears to have significantly outperformed expectations, pretty much across the board, for the quarter ending June 2025. It's a powerful statement, really. So let's kick things off with the absolute top-line figures. When you first looked at Microsoft's Q4 2025 report, what were the big headline numbers that immediately grabbed your attention?
Well, what's fascinating here is just how decisively Microsoft beat expectations. They reported a total revenue of $76.44 billion for the quarter. That translates to an 18.1% year-over-year increase. Pretty solid.
18%.
And for earnings per share, or EPS, that's essentially, the slice of profit for each share, they hit $3.65. That's a significant jump from $2.95 a year ago.
Okay.
And if we connect this to the broader market sentiment, these numbers truly surpass the Zacks consensus estimates, which, for those maybe unfamiliar, that's the average forecast from Wall Street's leading analysts.
Like the benchmark.
Exactly. Revenue came in 3.7% above the $73.71 billion estimate, and EPS delivered an even more impressive 8.96% surprise over the $3.35 consensus.
Wow. So nearly 9% beat on earnings. That's strong. A strong opening statement then for Microsoft, clearly exceeding what the financial community was predicting. But as we always say, true deep dive isn't just about the headlines, is it? It's about understanding the underlying currents.
Exactly. And this raises an important question. While those headline numbers paint a positive picture, the real insight into a company's underlying health, that often comes from its key metrics, specifically revenue broken down by segment. These are the engines, really, that drive the overall top and bottom lines.
So if those are the engines, how did Microsoft's three major business segments perform? I'm particularly interested not just in their actual reported numbers, but how their growth stacked up against what analysts were expecting for their year-over-year changes.
Yeah.
Any big surprises or predictable patterns?
Let's break them down, starting with Intelligent Cloud. This segment, home to Azure and their server products, it showed a strong 26% year-over-year change in revenue. Now, that significantly outpaced the 8 analyst average estimate of 19.2%.
26 versus 19.2 expected. Okay.
Yeah, so that's a clear signal of robust, maybe even accelerating growth in their cloud services.
Right.
Now, here's where the nuance comes in. While the rate of change vastly exceeded expectations, the actual reported revenue for Intelligent Cloud was $29.88 billion, which, surpassed the $28.94 billion estimate. But this specific dollar figure represents a 4.8% actual year-over-year change.
Ah, okay. So the rate beat expectations handily, but the actual dollar growth year over year was closer to 5%.
Precisely. And it's crucial to see both aspects, right? How much they beat the expected growth rate, which speaks to momentum, and the absolute growth in the revenue amount, which speaks to scale. Both are positive here, definitely.
Got it. That makes sense. What was next?
Next up, productivity and business processes. This includes, those powerhouse products like Office 365 and Dynamics. This segment's revenue showed a 16% year-over-year change, again, comfortably exceeding the 12% average analyst estimate.
Okay, so another beat versus expectations on the growth rate, 16 versus 12. But hold on, you just mentioned a 16% year-over-year change relative to estimates. Our sources also mention an astounding 63% change in the actual revenue figure for this segment. That's a massive difference. Can you unpack that for us? How can both be true?
Absolutely. And this is where it gets really interesting. You're right to flag that. The 16% figure, that refers to how much the year-over-year growth beat the analyst estimate for that growth rate. They expected 12%. It came in at 16%.
Okay.
But the actual revenue reported for this segment was $33.11 billion, beating the $32.15 billion estimate. And this reported dollar figure saw an astounding 63% change year over year compared to the previous Q4's dollar figure.
63% actual dollar growth year over year. Wow.
Exactly. It indicates a truly massive surge in the scale of this part of their business, far beyond just beating an analyst's growth projection. It suggests, a significant expansion in the adoption or maybe the monetization of these core productivity tools.
That's incredible. A huge driver then. Okay, what about the third segment?
Then we arrive at more personal computing. The year-over-year change in revenue for this segment was 9%. Now, what's particularly noteworthy here is that it dramatically outperformed the average analyst estimate of a negative 0.3%.
So analysts expected a slight decline, but it actually grew 9%.
Well, it grew 9% relative to that negative expectation. It performed much better than the expected decline.
Okay, that's a really important distinction you just highlighted. Outperforming expectations for a decline, yet. I see our sources also say the actual reported revenue decreased 15.4% year over year. For someone just glancing at the headlines, a decrease of 15.4% year over year for a major segment would sound like a red flag. How do we reconcile that with it being much better than expected? What does it really tell us about the underlying health of that specific segment?
It tells us a critical story about market expectations versus reality. You're absolutely right. While the segment, which includes Windows, Xbox devices, it did see its reported revenue of $13.45 billion, which still beat the $12.6 billion estimate, mind you. That figure did actually decrease by 15.4% year over year compared to last year's Q4.
Right.
But the key is analysts had predicted an even steeper decline, down 0.3%. So it's a case of performing better than a bad forecast, but still facing, headwinds. It's a great example of why looking at multiple metrics and their context provides a much richer understanding than just a single number. This segment is clearly in a different phase compared to the others.
That makes perfect sense. Better than feared, but still contracting year over year.
Yeah.
That segment level breakdown truly clarifies the growth drivers and the areas of contraction. But what happens when we zoom in even further? Our sources delve into individual product and service offerings. Were there any surprising winners or perhaps some more persistent challenges at that more granular level?
Yeah, when we go deeper, we definitely see some clear trends. Dynamics products and cloud services, for instance, brought in $2.14 billion. That's up a robust 24.3% year over year, also exceeding estimate.
24% on Dynamics. Strong.
Very strong. Search and news advertising revenue also showed healthy momentum, $3.59 billion, marking a 13.3% year over year growth. And server products and cloud services, a critical component of intelligent cloud, that was $27.88 billion. That marked a solid 4.7% year-over-year increase.
Okay, still growing, part of that bigger cloud picture.
Exactly. And enterprise and partner service revenue was $1.99 billion, up 6.5% year-over-year. So, these are all thriving components.
Right, lots of green arrows there.
However, one area that continues to face significant challenges is Windows and devices. This segment generated $4.33 billion, but this represented a substantial 33.3% decrease year-over-year.
Oof. 33% down. That's quite a drop.
It is, and it's definitely a point to observe closely, especially considering the broader, more personal computing segment's nuanced performance we just discussed. It kind of reinforces that Microsoft's traditional software and hardware revenue streams are, well, they're truly in a different trajectory than their cloud and productivity offerings.
That really seems like the key takeaway here, doesn't it? By dissecting these specific offerings, you get a much clearer picture of which parts of Microsoft's vast empire are thriving and which are facing these structural headwinds. It's not just a quarterly blip. It paints a vivid picture of Microsoft's ongoing fundamental pivot, moving away from legacy software dominance towards, a cloud for subscription-based future. That feels like the real story beneath these numbers, offering you, the listener, a truly well-informed perspective.
Absolutely. And given these overall strong results and that underlying growth story, it's not really surprising to see how Microsoft's stock has performed recently. Over the past month, shares of Microsoft have returned a positive 4.2%.
4.2% in a month. And how does that stack up against the broader market? Does it reflect maybe a stronger vote of confidence from investors?
It certainly seems to. Microsoft outperformed the broader market. The Zacks S&P 500 composite, that's Zacks' own benchmark for the overall market, it had a plus 3.4% change over the same period, so Microsoft edged it out. Plus, the stock currently holds a Zacks rank, #2.
Which is a buy rating.
That's right, a buy rating from Zacks, indicating their analysis suggests it has the potential to outperform the broader market in the near term.
Right. And understanding these comparisons and expert rankings, it isn't just trivia, is it? It provides a vital lens through which, well, you can project a stock's potential performance and grasp the financial community's sentiment about the company. Helps you see where the smart money might be looking. So to recap our deep dive then, Microsoft's Q4 2025 was marked by strong revenue and earnings beats, driven by incredibly robust performances segments like intelligent cloud and productivity and business processes. We also saw some fascinating nuances in how to interpret those year-over-year changes, especially in areas like more personal computing and specifically Windows and devices.
Yeah, and this raises, I think, an important question for you to consider as you digest all this information. What do these distinct shifts in Microsoft segments, the booming cloud services, that massive growth in productivity tools, and the continued decline in Windows and devices revenue, what does that tell us about the evolving landscape of technology itself? It's a big question. How might a company of Microsoft's scale and history strategically balance these, traditional revenue streams with these rapidly emerging growth areas as it looks to define its future?
That's definitely something to mull over for sure,
Yeah.
a balancing act. Well, that's it for this deep dive into Microsoft's latest financial results. Thanks for joining us, and we hope you feel a little more well-informed.
Subscribe to my channel Report Stock.